Thank you, everybody, for joining us again today. We've got a very special podcast video today featuring Marvin Toy, who's the tax and estate planning consultant that we work with at Equitable Life of Canada. I won't do his full intro. I'll let him do it right now. But really what we're going to talk about today is why are business owners in Canada buying big whole life policies, and give a couple of examples that we've gone through and that Marvin's gone through pretty recently. And I think that this is something that you're going to see and hear a lot more about, especially just as, you know, with the craziness that's happening with inflation, with the craziness that's happening with the taxes on businesses, on passive income. Just having the right plan becomes that much more important. Marvin, if you wanted to give yourself just a quick little intro, we'll get started.
Thanks, Ron. Thanks, Robert, for having me here today. I thought we were doing a podcast, so I didn't comb my hair, but I would do that next time. So, my background, I started off my career about over 25 years ago as a tax lawyer, and specializing in helping owner-managers of businesses manage their tax burdens and reduce their tax costs as much as possible. And I got really bored of that because it's really boring. So I moved into the financial industry, and I've worked for a number of various trust companies, doing estate planning for clients, doing estate administration, doing trust administration. And then I started working for insurance companies because I learned, to my great surprise through this journey, is that one of the best tax advantaged opportunities available for my clients was life insurance. So when I learned that, I thought, well, maybe I should move into that arena a little bit more because it seems to be a lot more interesting. So that's how I came to be working for Equitable Life, which is a 100-year-old life insurance company in Canada. And it is a mutually owned company, so that when clients buy a participating policy, a certain type of policy from our company, they actually own a piece of the company. There are no shareholders. You can't go buy our shares on the stock exchange like you can for some of our other major competitors. And it gives our company a really great advantage to our clients because there's no dividends going out to the other shareholders of the company. So it's a great place to work. I'm really happy and thrilled to be working with you two fellows.
Marvin, I've been kind of itching to ask you some questions. You have such insight because what separates you from just talking to one advisor, you work with advisors across Canada, right? Seeing what they're doing with their clients and kind of supporting them. Is that right?
Yeah, actually, I work only in Western Canada, so that's still a lot of Canada, obviously, but you are correct. I work with all sorts of financial advisors across Western Canada, and I get to meet their top clients and their emerging clients. And I get to see all sorts of different financial plans, all sorts of different corporate structures, and help out with those and give my thoughts about them. And it really does give me an incredible breadth of knowledge about what's happening in the marketplace.
Yeah, that's why I think Laurent and I love talking with people like you, is because you have that view of what's going on and why are people doing different strategies and planning and that sort of thing. So the biggest question I have for you is, we work with mainly business owners, younger business owners. What do you see, and why are business owners, particularly younger business owners, purchasing whole life insurance?
Yeah, that's a great question, Robert. And what we found out there is that when business owners start to get successful, they start to, try to save some of their money, right? They're not just investing into their business anymore. They're starting to think about the future. They're starting to think about, the time that they get to retire and slow down a bit. And they start to think about, how am I going to take care of my children and provide a legacy? Because, for a lot of our successful clients, they quickly come to that point where they can see that their endeavors are going to create more wealth than they're ever going to need in their lifetime. So they want to do something with it for their community and for their families. And so one of the really exciting things that I see out there, Robert, which was really the evolution of Canadian society over the last 25 years, is how so much of that wealth now is being generated by women. We always think, there's a big glass ceiling and stuff like that. And I know it's three guys talking here, but, it's really astounding, that when I was in school in university, guys were still, the majority of the students in universities. And now, as we all know, even over the last 20 years, women are really becoming the well-educated professionals. And then once you add 20 years onto that, they're now tops in their fields. All types of fields out there, chiropractors, dentists, doctors, lawyers, accountants. We're seeing these amazing, successful women out there. And a lot of the marketplace hasn't been focusing on how to help them because, women and men are a little bit different in their outlooks in life and in their beliefs and responsibilities in their lives. And so we're seeing some incredibly great planning being done for women like that. And for a lot of these women, whole life insurance is a big part of what they do because it makes sense for their goals.
To just expand on that a little bit, could you, obviously without giving away any sort of personal information or anything, but could you maybe expand? So maybe think of like one of these women that you worked with recently. What's a quick case study? Like what was she doing it? Why was she doing it?
Yeah, absolutely. Something that we just helped in the last couple of months here in 2022. It was a situation where we had a mid-40s lawyer, a woman who is tops in her field, in the field of tax planning and in the field of estate planning. And she's been doing very well. And like many professionals, she runs her business through her professional corporation to take advantage of the low tax rates on anything she can save in there. Here in BC, of course, that's 11% for 2022. So whatever she can save inside this professional corporation, she only pays 11% tax on. So she was doing very well over the last few years and investing well through her financial advisors, and had reached the point where she had about $1.5 million inside of her professional corporation. Well, as you gentlemen know, and I'm sure you let your clients know, the federal government, provides this tax breaks to businesses, but it doesn't really like it when those business people invest for their own futures. So they will say there's a tax provision that came in a couple of years ago that says if those profits are being used in financial investments, and sometimes people use the term passive investments, the government will start to claw back that low tax rate that they're enjoying, that 11% tax rate. And they basically say, if you earn more than $150,000 a year of passive income inside your corporation, that entire 11% tax rate is gone. And instead you'll pay tax at 27%. Well, that's a big jump, right? That's a 16% tax rate. That's an increase, more than double what you'd be paying otherwise. So as being a savvy tax lawyer herself, she wanted to know, what's the solution? And she's been starting to hear that people were using life insurance as the solution. So she spoke to her advisor who brought in our team at Equitable Life. And we explained to her that if instead of investing in things like stocks and bonds, which are available from a lot of financial advisors, as she instead started investing in a whole life participating product, she could be getting gains inside that participating product, which do not get taxed and would not reduce her 11% tax rate in the corporation. So when we worked this case with this tax lawyer, she understood what it meant and understood, hey, this is a great way to build some wealth for my family and for me in the future to use. And so we provided a proposal to her where she's now going to be putting in $200,000 a year into this product. So that is really a very typical situation where we have young professionals doing very well, trying to save for their futures and trying to make sure that they maintain their qualification for a low tax rate and using a whole life insurance to do that.
We've actually banged on that passive income drum quite a lot since those new rules were implemented, and yeah, we have a great solution. We've been in the room with the accountants and with the lawyers, and at their conferences where they, the accountants and the lawyers just learn what the new rules are, but they don't learn how to deal with it. It's just, well, now this is how you account for it, not this is how you can solve it.
Can you touch on, Marvin, a bit? Obviously, it's amazing what you just touched on. I think it's spot on with, especially with what we're seeing with the passive income rule changes. Can you touch on a bit, well, of corporately held life insurance and the tax exempt status of life insurance in Canada, and why it's used, and yeah, maybe touch on the kind of the tax exempt status of a life insurance policy.
Yeah, that's a really great question, and not many people ask me that, Robert, and so it's fun for me to answer that kind of question. One of the things that when most Canadians look out at the the financial situation in Canada, the financial marketplace, they don't understand is, why do we have the system that we have? And when we look back historically, Canada is a relatively young country, right? Like, what are we, 150 years, something like that, since 1867. Canada, when it first was created, everything needed to be created from new. So the Canadian financial system is based on what we call 4 pillars. And those 4 pillars are, number 1, the banks, number 2, securities companies that go out and sell stocks in companies, number 3, trust companies, and number 4, insurance companies. Okay, so those concepts existed before Canada was even created, of course, and they were brought into the Canadian system. So why do insurance companies exist? Well, insurance companies exist, of course, because bad things happen to people, right? And so if people are trying to build a nation and want to protect what they're building, they need insurance companies. So one of the things that came up right from the very beginning of the creation of the Canadian financial system is the decision that when money is invested in an insurance company, there is no tax on the earnings that the insurance company makes. Okay, and so that is an incredible advantage. If you are a bank and a bank goes and invests money, they pay tax on that money. And if a trust company does it, they pay tax. And if a security company invests, it's the same sort of thing, they pay tax. Life insurance is the only part of the Canadian financial system where you're not paying tax on your earnings. So, and that's because it's insurance. It's just the way it's always worked. So now we come to our modern times, 100 plus years later, that still continues to exist. So when a business owner today owns a corporation and invests in a participating life insurance policy, their gains continue to not be taxed, because that's just the way the whole system is set up.
That's amazing. So this business owner that you're talking about can grow money within her corporation on a tax deferred basis. So the growth within that policy isn't taxed. And then now there's kind of the other piece in Canada as well, right? Life insurance in Canada pays out tax-free as well. And one of the key parts of obviously a corporation is if owning life insurance within a corporation, if it pays out to the corporation, and it creates something that a lot of people don't know about, which is a capital dividend account. And that's kind of the other benefit, I guess, of when you're talking about legacy, estate planning, that sort of thing, where the capital dividend account, or CDA, is such a amazing tool. Can you touch on, like, what is the CDA? How does it work? And then why is it such a benefit for business owners?
Again, a great question, Robert. So most Canadians know that if let's say somebody's out there and their mom decided to buy a life insurance policy for the family, for the kids, if something happened to mom. Most Canadians understand that if mom dies, or when mom dies, if she buys a permanent policy, that payment will come to the family tax-free. Everybody understands that, right? No one expects to pay tax on a life insurance policy. And part of the reason for that, of course, is that mom would have paid for those premiums out of her own pocket, after-tax personal dollars. So since she used after-tax personal dollars and it grows tax-free for the reasons we explained, what her family gets is also tax-free at the end. Most Canadians understand that. So when we introduce a corporation into the system, we have to understand that the Canadian system tries as much as possible to make the taxation of corporations as similar as possible to the taxation of people. So if a corporation goes and buys a life insurance policy, which is what happened when we talked about this tax lawyer that we helped, she's using corporate dollars. So let's say she was putting in, as in this case, $200,000 a year into this policy. And let's just make a really simple example, Robert. She pays a $200,000 premium, and unfortunately, she passes away right away. Okay, and if that, let's say that policy pays out to her corporation $500,000. So there's a $300,000 gain. But when that money comes into the corporation, all goes into the corporation completely tax-free, because that's what life insurance policies do. You don't pay tax when you receive it. But when that tax lawyer's family wants to get access to the death benefit, that $500,000, then some accounting has to be done. The government will say at that point, well, how much of that $500,000 is the company's money, and how much of that $500,000 is the life insurance company's money? So we know, of course, that she paid $200,000 for the policy, so that's the company's money. $300,000 is the life insurance company's money. So the accounting rules, the Income Tax Act rules, say that that $300,000, which is the life insurance company's money, can be credited to the capital dividend account. And as you know, and many of your clients know, that if you have a credit in your capital dividend account, I like sort of call it like that's like your air miles. It's not cash, but it's a balance for you there. If you have that balance there, that means that the corporation can pay a dividend up to $300,000 tax-free to the shareholders. So therefore, after this lawyer had passed away, the corporation would be able to pass on $300,000 out of the corporation tax-free to her family. And that's the benefit of the life insurance.
And that's significant, obviously, because if you had to dividend that out another way, you'd have to pay income tax or at your dividend rate.
Yeah. So for that other 200 that the company got back, from the life insurance company, when they try to pay out that 200,000, the family is likely going to pay up to 40% tax on that. So when these things really work out well, of course, that was a very simplified example. If the situation works out well for this lawyer and she lives a good long life, which we all hope she does, she's in her mid 40s now and she lives 45 years, this policy's death benefit, is hopefully going to be in the range of $8 million or more. Okay. So how much would she have paid during her lifetime on this policy to get that $8 million death benefit? It'd probably be at most $4 million. So $4 million of corporate money would go in there and her family would get $4 million tax-free, at least $4 million tax-free. She'd probably get a little bit more because there's some other rules in there that would reduce her cost over time. But ultimately, the point is that she would, if she didn't do this, she'd have $4 million in her company. She'd have to pay tax on the whole thing. By doing this, she doubles her money. She still has the 400 coming back, and yet she still gets her family gets 400 tax-free. It is an incredible wealth building opportunity and creates the situation where she can now fund a great legacy for her family.
And so this lawyer, she's, like we talked about, she's growing the money within her corporation on a tax-deferred or tax-free basis. She's then, from a legacy standpoint, leaving it to her family in a tax-favorable way or a tax-free way. It's going to pay tax-free to the corporation, and a large portion of that is going to flow to the family, all tax-free. Okay, that's awesome. So that's great. That makes total sense why we're seeing so many business owners using insurance as a tool. What are they using it for in the meantime? So that's great, like kind of long-term. Obviously the life insurance portion is that long-term, but what are they using it in? Do you see them using it in the meantime? Like we talk to business owners about, it's not necessarily that $200,000 is tied up and gone, right? Like they have access to that.
Absolutely. And that's a really big part of it for a lot of clients is when they say, hey, listen, I'm going to make an investment. They say, well, yeah, but I want to see it, because they've been used to, in many situations, putting it into a financial institution with their securities companies, brokerage, or whatever. And they get a statement. They say, hey, listen, I put in so much money and here's what it is now. And they know that if they want to get that money, they can go sell some stocks or something like that. And they can get their money if they ever needed to go buy a house or a second home, or if they want to even reinvest inside their business, right? So that's the great thing. When fellows like you meet clients who say, listen, it's very important for me to be able to get access to some of this value that they're putting in. This lawyer's putting in $200,000 a year. That adds up after a while. She may say at some point in time, listen, I want access. You would make sure you design that policy so it's a type of policy that has cash value, okay? And cash value means that cash value belongs to the policy holder, in this case, the corporation. And they have a right at any time to come get that money from the life insurance company. Contractually obligated, the life insurance company must hand it over to the policy owner, okay? Now, most people who'd want access would not actually come into a life insurance company and say, listen, I want to cash in this policy, because you don't want to do that. That's a loser move, okay? That's when you're giving up all the potential death benefit in the future just to have something today. You don't want to do that. And life insurance companies, if you came and said that, would be happy to do it, because suddenly we get the big windfall. We get all that, the liability taken off our books, and all those gains, we get to keep them. So don't ever do that, okay? It's sort of like the advice that you probably give your clients as much as possible. You never take your money out of something like an RSP until you're retired, right? It goes in there once and you take it out when you need to, but don't do it in between time. So clients can access their cash value in other ways. They don't have to just cash it in. One of the easiest ways to get instant access to that money is to come to life insurance companies and say, will you lend me some of that cash value? And we'll happily do it. At Equitable Life, we'll lend it back to the policyholder at 6.05%, I think is our current rate, something like that. And we'll just give you the money. No underwriting. You don't have to go to the bank and ask them for money and show your financials or anything. We will instantly lend you that money. And anytime you want to, you return that money. Okay. There's no repayment schedule or anything. So you have complete access to it. The other alternative for people is that they can go to a lender, a financial institution, for example, and say, hey, listen, I have this life insurance policy. Here's the cash value today based on the statement I got from my life insurance company. I would like to use it as collateral. So the corporation, let's say the corporation says, for this lawyer, she says, I want to, build a new office. I need, $500,000, to get a new office and set myself up. She could go to a financial institution and say, here you go. After a bunch of years, I've got $500,000 of cash value. And a bank will lend, in most cases, up to 90% of that value to the corporation, which is fantastic, right? If you think about saying, well, what else could I use as collateral? If you went to a bank and said, listen, I want to, use my home as collateral, and, city assessed value is $1 million, the bank is not going to give you $900,000 for that, right? They're going to give you maybe 75%. And if you went to them and said, hey, listen, here's my portfolio of securities, Bell Canada stock, CN stock, and it's worth $1 million. What will you give? What will you provide to me as a loan based on that collateral? They'll probably give you 50% of that. Why? Well, because we all know house prices go up and down, and there's a huge cost to seize a house and to sell a house and to get rid of it if a bank needed to take the security. And on your financial portfolio, we all know, of course, the stock market could crash, so it may not be worth $1 million. But a life insurance policy cash value never goes down, okay? Never. It can only go up when it earns a dividend every year. So therefore, a financial institution says, well, this is great. It can never go down. That's why we're willing to give up to 90% security on that. And the other thing about that is when that's handed over and someone needs to come claim security, just like the corporation could, they can just walk in with a piece of paper and say, cash this in. And a life insurance company will write the check. So it's the best security out there, and widely used as security when people need access to their cash.
So that's amazing. So we're talking about this lawyer. Again, this is going to go back to her. She's growing the money on a tax deferred basis. It's going to be passed on to the next generation in the most tax favorable way or tax-free way. And then she can access the funds that she's put into the policy and use that to invest in her business or invest somewhere else, buy additional real estate or do whatever. So what she's essentially done is she's, with the same dollar, created one asset, which is the insurance policy, and then she can leverage that to buy other assets. Is that right?
Absolutely. And that it is an absolutely common thing to do. Like even here at Equitable Life, for example, some people will use that collateral loan, get the loan from other places, but some people just from simplicity will borrow from Equitable Life. We have often between 10 and 13% of all the money, cash value, in our fund being lent right back to our customers. They do it all the time. It's such an effective and efficient way for people to get at their money.
I mean, we see this with real estate. Sorry, we see this with real estate a lot, right? People buy, an investment property and they build up equity in that investment property and then leverage that property to buy more properties, etc. Would you relate it something similar to that? I mean, Canadians love real estate. I don't know if that's comparable.
It's absolutely similar, and it's often when we're explaining that to clients, Robert, we use that exact same analogy. And, we talked in this one case about a lawyer using it. Some of the biggest customers that we have for buying these participating policies are real estate developers and owners of real estate because they use it for all the reasons that you said, and it just works perfectly for them, and they totally understand it.
Could you give maybe like a little story, maybe about one of those real estate developers, say, from when they started to what they did with it and maybe paid it back and did it again?
Yeah, absolutely. So as we all know, when people are in the real estate business, so this, they're just building it all up, they're taking on a lot of debt, and their lenders will say to them, well, you know what, we're trusting you with a lot of money, and yes, we're going to try to take collateral on your development, but you know what, we need to have some life insurance on you too, because you're the key guy, right? Or a girl, if you're doing this real estate development and you get hit by a bus or, or something like that and you die, yes, we could go in there and take your project, but what are we going to do with a half to finished condo building, right? Or a half finished strip mall? Like, does, the Royal Bank really want a half finished strip mall? Okay. They can't earn anything on it, and they've got to invest a huge amount into it to get it done. And they're certainly not real estate developers. So they will go to their big borrowers and say, well, you know what, you got to get a life insurance policy. Okay. So in case you die, we can get our money back. Now, once you're successful developers, and we work with a lot of them, start to, pay all for life insurance policies, they start to realize, just throwing money away, right? It's just like sort of everything else. You go buy your car insurance, you don't get into a car accident. Well, great, you didn't get into a car accident, but your premium's gone, right? It didn't go anywhere. And so they start to think, well, geez, what if there was, some way I could get some value for this expense that's constantly going out? And we tell them, well, there is. Go buy a different sort of policy, buy a permanent participating policy, so that every premium you're putting in there to protect the loans that's going out to your lenders is also giving you some value. And then on top of that, there's going to be that cash value in there. So over time, developers start to get successful, and they start to use their own money in some cases, and they don't necessarily need as much life insurance. So therefore, that collateral, the cash value in the life insurance company now becomes available to them. So then they say, okay, listen, I don't have to pledge this policy to a financial institution anymore. So I'm going to use that cash value as my own bank now. Okay, instead of going off to the bank and saying, hey, you give me money to put up my next deal, I'll use the money that I have in my own collateral, in my own cash value life insurance policy. And so that's what they do. And then on top of that, because fellows like you are explaining to them, they say, hey, listen, now you've also got this great big death benefit. If you get on later on in your life, you get to the point where you start to retire and you're not borrowing money anymore off this policy. Well, now you have this policy with a great big, huge death benefit on it. And when you die, your family's going to get it, as we explained. But it's going to do two things. First of all, it's going to pay your taxes on your real estate empire. Because when you're a real estate developer and you work with good accountants, they will always be helping the real estate developer defer taxes constantly, right? You want to keep building the thing. You don't want to pay taxes every year. You want to use depreciation. You want to use all the expenses you can to make sure your taxes stay low. Well, it's always just a tax deferral. And that tax deferral will end when the last of mom and dad die and they want to pass on this real estate empire to their family. So when that time happens, there's going to be a big tax bill. Well, guess what? Where's the liquidity coming from that? Nobody ever wants to sell a building when they're in the real estate business, right? They've been building up this asset for 20, 30 years, building it, paying it off. the last thing they want to do is start selling off chunks of it just to pay taxes to the government. So instead, there's the life insurance policy with the death benefit. The money is available to pay the taxes. Anything's left over is available to create an additional legacy for their family. So yeah, that is, I mean, I'm not going to tell you a specific story about that, Robert or Laurent, because it just happens regularly. That's what these folks are doing.
Right. I just want to also be conscious of time, just so we don't go too late. But like next couple of minutes, we'll wrap up. But I totally appreciate it, the stories, because that really helps to get the point across, right? One thing that we also haven't quite touched is that the benefits of this type of insurance, depending on the owner, will change over time, right? So say we'll go back to your lawyer friend, she's using it now while she's still trying to grow the business. Maybe she wants to buy her office or renovate it or whatever. But then later in life, when maybe she doesn't need to grow her business anymore, like how does this help with retirement? Is this something that can help with the retirement picture?
Yeah, absolutely. When that, let's say we get to the point where the lawyer has, used the cash value over time to build up her business, paid back to the policy, just like she would pay back any other loan, and she gets to retirement. Well, there's this big fat cash value sitting in this policy. Once again, that is no different from her having a great big portfolio of bonds or stocks sitting in her financial institution. When she wants to have access to that for her retirement purposes, she can go borrow that money either from the life insurance company or from outside lender, and then have that money, for example, dividended out to her, just like she would have if she was paying for her retirement with other financial products. So yes, absolutely, it's a normal thing for people to look on that cash value as a potential source of retirement income.
So, like, just to recap, she's growing the money in her company where that's not affected by the passive income rules. It's growing on a tax-deferred or tax-free basis. She's can access it to help fund her business or invest in other areas. She can then use it later in life to help supplement her retirement income. And then when she finally does pass, say at age 90, then she's leaving a very large tax-free payout that can go to the next generation, creating the capital dividend account, which we touched on, that will allow that a majority or a lot of that money to flow to the beneficiaries, all tax-free as well. So that's kind of the idea. So what you're telling me is this is why, for these reasons, the biggest reasons anyways, that business owners in Canada are kind of taking advantage of whole life insurance, and that's why they're purchasing, whether, like you said, incorporated lawyers or developers. We've seen, a lot of the incorporated professionals, doctors, dentists, that sort of thing as well. So amazing.
It's really any business person out there with a corporation are the people who really hugely benefit from this, Robert. People often think professionals as a special group, but they're just business people with a corporation, just like everybody else. Whether you're a plumber, an IT person, landlord, anything else, it's very widely used across all Canadian business sectors, and it's, as you say, it's largely driven first by the tax reasons, and then once people realize how flexible it is, then they really get excited about what they can do with it.
Marvin, I really do appreciate your time. I know that you're a busy guy and dealing with the whole of Western Canada and all of the other advisors like us. But we really appreciate your time. And to break it down into like a non-technical way, with telling stories about the lawyer, telling the stories about the developers, and giving some like examples of like how do you actually use this in your life. Oftentimes when you talk like with the tax and estate planning people, they're like, here's a PowerPoint slides with 1,000 word on it at 0.8 font that nobody can read and nobody cares about. The accountants and the lawyers care about, but no, putting it into like a perspective where here's real people doing real things in their day-to-day lives, and how does this affect over time? It's great.
I do have those slides. We can do that next time, Juan.
Right?
Well, and Marvin, your hair looks great too, so don't worry about that.
All right. It was raining out there. I thought it looked better.
All right. So we'll wrap it up, and then Yeah, I totally appreciate it, and we're happy to have you on again in the future as well. And especially if there's any cool stories like that, that's really what works the best with this kind of stuff. You're like, oh wow, this guy.
So many of those, Laurent. We'll do it again next time. All right.
Awesome. Thanks so much, Marvin.
Thank you, gentlemen.